Good afternoon. This is Serge with TradeJolt.com, and I'm going to show you an attractive opportunity that exists in the gold sector. Okay, let's begin with a little history. I want to show you how technical analysis can sometimes be quite accurate, often be quite accurate. This was an analysis made back on the 13th of April. And at the time, I had determined that gold was going to move up to 182.30, at which point I expected a peak and a probable retracement from there temporarily. Long term, I felt gold was going to move higher. Also at the time, I had predicted, as you can see this arrow here, this was before this occurred, I had predicted a correction down to this level. That's exactly, almost to the penny, what we got. And then from there, move on. So fast forward to today. First, the big picture. I see things moving up to this level here. This is a weekly chart. In other words, each candle represents a 1 week.
Move here represents a fractal with 3 waves in it and the downturn. That downturn being approximately 38% drop qualifies this as a wave. If that gets breached, and it did right here, then we can expect a second wave up to this level, which is what we got now. It can go beyond that level, and I'll show you in a second why I think it will, but it doesn't have to. But this second wave, if this gets breached, that happens, I would say, about 70% of the time, and it's something that I like to bet on when I see it occurring. So at this point, a breach right here, like you see here, is a great time to take a bet towards a duplication of that wave this level. All right, we're already at that level, so that's not what I'm playing on today. But analyzing a little bit further, looking at a 14 and a 50 period RSI, I see if I were to trace here between the highs, we'd see that it's converging upwards, as is this. That's telling me that this wave is, or rather this trend of upwards movement in gold is not finished. Since I believe we're still in an uptrend, we should see an ultimate culmination around the 234 level, at which point we could expect a large retracement back down into this area. That's what the weekly charts tell me. Now let's look at daily charts and see if we get confirmation. So on the daily charts, I had determined here was a wave. A second wave should have taken us to here. It's what we got. And then a third wave should have taken us up into this area. At this point, if things are not very, very bullish, you almost expect immediately a retracement. We didn't get that. It kept on moving a little bit higher, but we get a pattern that is reminiscent of something we saw here and again here. These kind of candles like this are called dojis, and they represent, let me kind of draw them for you so you see what I'm talking about. They look something like that, like a cross pattern. You see it here and here and here and here and here. Sometimes the midsection could be a little bit longer or wider. So that represents bulls fighting bears and uncertainty prevailing where neither side really wins, and it kind of remains in the middle point. Those are reminiscent of the ends of cycles, or rather, not reminiscent, but typical of the end of a cycle. So I think we're approaching that end of the cycle. Actually, yesterday I made this video and then I had to re-record it because my wife was talking loudly in the background and it was almost impossible to hear me. That's what you get from working from home. But that's what happens in these corona times. So I actually can't tell you now, but actually yesterday I predicted we'd get this drop here, and I anticipated a little play on it. That had I put it on this morning would have been a good little move. I got really busy and I did not put it on, so we did not make the money. So I won't even go into that. But I will discuss a larger trade once I'm done here. So this is two things to mention here. Number one, the fact that it breached this expected wave high by a few points, that is typical of a very bullish pattern. The more it breaches past the anticipated Fibonacci high, the more bullish the trend. See if there's anything else I want to point out here. No, that's about it. At this point, we could anticipate a drop. Typical is the drop reverting to from low to high of actual move made, all the way down by 38%. Sometimes it can be 61%, but in a wave that is very bullish as this one, you'll typically just see the 38% retracement. So we could see gold move all the way down to 170, 172. I would guess 172 because that's where we have a lot of resistance, not before then. We have a couple of gaps here, or it gapped up from here to here, that quote unquote want to be filled. So that would not surprise me to see, and perhaps a little bit later I'll show you a play to the downside where we bet on that temporary downturn. First, I'm going to show you a long trade, betting on what I showed here using the weekly chart of an ultimate high in the 234 level. For that long trade, since I'm using options, time is very important. So let's look at how long it could take for that to occur, for it to reach that level. So I've taken a little bit of time to add a timeline to my weekly chart here. It gets kind of busy, but let me explain it. The larger cycles here represent from the low to the next low of the larger cycle. Then we get one starting here that will peak out somewhere at this point and then start heading down. So, and that is made up in and of itself. These are fractals, so you have cycles within cycles. So here's the low to the low of this first wave, and then you start with a low here, and I anticipate another low to be about here, and that would take our third low, well, the high, to occur sometime between October and November, and then a drop right around just during or right after the elections, which would be around November 8th, I believe. That would also make sense in terms of the second wave of the coronavirus, which has been breaking out and causing a lot of uncertainty and really panic in certain sectors. Gold is likely to act as a contrary indicator. Gold tends to be a place that people flee to in difficult times. Right now, as Congress is getting ready to pass some form of legislation with yet more money printing, it's likely that more and more people will see future inflation looming and will want to take haven in gold. That could be another reason for what we see on the technicals here of a very strong bullish pattern for gold. So as far as the timeline, I would see this thing peaking out sometime between November and December. So that's when we would want to have our options extending to, and the optimized option would reach its peak around mid to beginning to late November to give it a little bit of wiggle room. So that's what I will do. So let's go on to our, well, actually, before we do the time price analysis, let me mention this is my daily chart. So I do anticipate before then a drop down to these levels, and I'll show you a second trade that plays on that. Now that will take less time. If we look here, after it reached that cycle and got into these doji patterns, the drop was very, very quick. That's typical of drops. Drops take a lot less time than rises. And I think that we'll see the same thing. This thing took, let's see, about 2 weeks to occur. And I think we will see this drop down to here over a 2-week period. We'll give it 3 weeks to be on the safe side. But that would take it to about the end of August 30th, thereabouts. So we might have a second trade to put on for August 30th. I haven't prepared that trade yet, so I'll see if I get to that today. But I'll show you the long-term upward trend. And it makes sense to put on, in fact, I just put it on today. We might get a much, much better buying price if I'm correct and this occurs. But you'll see that the buying price that I got is already so attractive that I didn't not want to put it on. Sometimes the perfect is the enemy of the good, and it doesn't always have to do this reversion in a very strong upward trend, which is what we have. You don't always get the correction down. So again, I wanted the good enough to be something that caused me to take a position today. All right, so let's go on to that position. So, okay, this is my longer term option trades. Remember, I was predicting mid-November, early November to mid-November. So this is set on that time frame, and this is a more complicated trade than I usually put on, but the risk reward is really, really attractive. I just put it on today. I think it cost me $122. Here it says $119, but you get a little bit of I think a little bit of friction between buying and selling. It cost me $122 to put this position on. I put about 35 of these contracts on for different customers. And you will see, including myself, you will see that for every, this is per contract, for every $1, or rather one contract, one position, one customer, so to speak, for every $119 that is at risk, if gold actually does move into this territory, of $212, we will make somewhere, we could make as much as a $1,400 return. You never actually get that. For that to happen, it would have to be at this 200, I believe that's a $215 level on exactly the expiration date of the 20th of November. It's rather unlikely that I get exactly that. More likely it'll be somewhere in this range here, but that's still $1,000 to $1,100. That is about a 10 to 11 times risk-reward relationship. This is actually let me show you this broken down into the parts so you understand a little bit what I'm doing here. What I did is I took a butterfly, which was a very narrow butterfly trade, and as you can see here, the butterfly, if you can nail it, butterflies can make a lot of money with very little money at risk. But for them to make that kind of money, you have to have them very narrow in price range. So this risked $8 in order to make $500, but of course it requires you to get the price right within that time frame to a very narrow degree, and that's very difficult to do. Prior to that, it can make money. Let me show you, say, an October timeline here. So as you can see, it makes a little bit of money prior to that if gold is moving up, but nowhere near the amount it makes at the end because of the erosion of time in your centered short contract points. So I combined that with a more tolerant broken wing butterfly, which has this kind of structure. This one risks $100 to make a possible $900, and as you can see with the timeline, by mid-October it's already quite a bit more. It's about a 3-to-1 risk-reward relationship. By combining the two, I get that more attractive overall relationship. So I don't, unlike with a traditional butterfly, I don't need to get the price exactly right. If it goes higher faster than I think is possible, I have a margin for error. I'm going to make in the $400 range at every price level above $220. I don't think it's going to reach $220 by November, but if it does, I still make about a 4-to-1 reward. I make 4 times what I've risked in order to put on this trade. And if it takes longer for this to happen, with the butterfly, I would not make much money at all. Here, I'm already by October, let's say by mid-October, it's reached this, what is that price level? It's reached the 207-ish price level, or a 205 level. Well, I've already made, I risked $119. At this point, I've recovered my 119, and I've made an additional 150. That's a 100% return. If it looks at that point like gold is losing its momentum and some news comes out that is bearish for gold, well, we can exit the trade still 100%, 150% gain. So it's much more forgiving than just the butterfly would have been. So that's it. That's the trade. I hope you like it. Let me show you something else. Let me show you how volatility impacts this. First of all, I've added the columns of Vega here. And if you look, this thing this is Vega multiplied by the number of contracts. So you see we have, we're short Vega on our short positions, our 4 short positions, which yield a total of approximately $1,560 that benefit from, in this case, this is zero volatility, that are benefit from each 1% drop in volatility. So any 1% drop in volatility will, because it's a negative, it increases my profit by $1,560. On the other hand, any increase in volatility by 1%, I tend to lose value here. So basically these two work at counter effects, but if you add those together, you'll see this is largely, excuse me, I'm a little bit confused. It's just the opposite. These benefit from increasing volatility, hence the positive values, and this is negative. It value if you have increasing volatility. But the two negate each other. If I add those 3 together, let's do that real quickly. 569 plus 467 plus 643. That totals 1,679. You subtract 1,560, and that's only about a $119 move for every 1% rise or drop in volatility. I'm gonna show you that in a different way here. That's not a very big move, and I'll show you that. Let me have volatility rise by 50%, and this is not on the day of expiration. This is on that October date, and as you can see, the difference here is not that significant in the price. It doesn't cause it to go negative or positive. And if I add volatility down, that's the green line. It's almost barely a difference here. You can see it's not that much of an impact on the overall trade. So you don't need to be too concerned by increasing or decreasing volatility, contrarily to a lot of option positions such as calendars and spreads and other type of trades. Okay, so that's it. I will briefly interrupt this to show you, I'll end it with this, and then on another video I'll show you a downside trade for the shorter term. So basically that's it. I hope you like this trade. I invite you, if it's in your risk profile, to go ahead and put it on for yourself. It's not too late to do so. But make sure you understand what you're doing. Options trading is complicated, and you shouldn't be doing it unless you have experience with it. If not, you might want to use a virtual software to allow you to place these trades using paper money, so that you learn how to do this. If you like this video, please subscribe so you're notified when we make others, and hit the like button. That's how we move up in the rankings at Google, and it's our way to gather more subscribers and eventually get the word out. Thanks a lot for subscribing, and I look forward to seeing how this trade progresses.